being streamed? Because this is a public meeting.
It's a public meeting, which is why we're here.
Yeah.
Members of the public have been invited, and members of the pension board have been invited, but as usual there are no takers.
Okay. Just
right, I'll start then. Good morning, ladies and gentlemen, and Emma from Scotland. Welcome to our first meeting. Could I please ask mobile phones switched off, turned off, put on mute, please? We have apologies from two people, which is Councillor Ward and Councillor Jarman. The Pensions Committee at the moment consists of only 6 people. Inadvertently, the non-voting group only elected 3 people onto the committee, and in fact they should have elected 4. But apparently I think we have to wait till the next full council meeting before we can add anybody to the pensions
can
committee.
I just clarify? It was actually 331. I think you'll find, Chair.
It is, but if the one is the chairman of the ruling group, then that becomes...
It's not. It was 3. Yes, he's one of the 3, but the split was 3,
Yeah.
and 1 to the others.
As I understand it, the political proportionality of the Pension Fund Committee is 3 Conservative, 3 from the Alliance Group, and 1 from the others, and the others being the remaining 3, the Labour, the Liberal Democrat, and the Vexist Party. So that nomination, because the nominations at full council were only from the larger parties, or the larger groups, shall we say, that final space was always going to be a vacancy until the next committee. So we're waiting for either the Liberal Democrat member, the Labour member, or the Vexist Party member to nominate one of them to be the third, the 6th member. So
Thank you, Chair.
Sorry, the clarification of that. Declarations of interest, please, from anybody.
Sorry, Chairman, we need to just confirm the minutes first, please.
Right, now we'll go to the minutes. Only Councillor Andre and I were here for the last meeting, and as far as I'm concerned, do you agree?
I'm happy to second it.
Right, I'll sign them now. So they're duly signed, and then public question time. I didn't see any questions from anybody.
None have been received, Chairman.
Right, we'll move on. Introduction. Obviously, you've all got your agendas in front of you. In which case, I think we hand over to Joe Thistlewood.
thank you. Members, welcome to the Pension Fund Committee. Planning to give you, as I said previously, a lot of information today. Some of you, Debbie and Vanessa, thank you for coming back. You will know this, but it's always helpful to have a bit of a refresher. For the new members, could I just check, members, are you happy for me to call you by your first name, or would you like to be called Councillor? Thank you. I'll just clarify on that one. Thank you very much. So this is going to give you a huge whistle-stop tour of what the local government pension scheme is in its national context, linking that into the local context in terms of what the Isle of Wight Council Pension Fund is and how we fit into the national scheme. We have our advisor from our investment consultants, Emma Garrett from Hymas Robertson, who will be delivering some information about our investment profile, which is one of the detailed papers that you've got in here. We've also got Matthew Collier, who is our administration team manager, and Joe Cook, who is our accountant, pension fund and treasury management accountant, as well as myself. We're not going to go into the detail of what all of us do today, but just an overview if you've got any questions, then one or other of the officers or the advisors should be able to help you. I will share the slides after we've had the meeting so that you can go through them at your own leisure. There are website links in there and you can have a look at those bits and pieces. There will be some training slides that I'll send through and links to training modules that you can do to bring your knowledge up to speed. And we need to work out how we're going to deliver some more in-depth face-to-face training, or not face-to-face necessarily, but Teams meeting, virtual sessions from our advisors on the different topics in more in-depth so that you've got a broader understanding. It will be quite a steep learning curve, and I make no apologies for that, but there's a lot of things going on in the pensions world in general, as well as not knowing, kind of where you're coming from, the new councillors, not knowing where you're starting from to an extent is probably a better place to be, because you haven't got the history of having to change, whereas we can bring you in fresh with the new operations, etc. So please bear with me. Do stop me and ask questions at any time, and I'll just make you move on this one. So it looks as though we're going to cover a lot, but I'm going to do it quite quickly, but take time for questions. So we'll start off with looking at the local government pension scheme as a whole, and then we'll bring it into specifics to the Isle of Wight Council Pension Fund with who we are, what we do, key bits of information for us. And then we'll start looking at how to bring your knowledge up to speed and what we're going to be doing in the future and how we balance this workload and knowledge sharing, etc. So, what we're going to do is not designed to be a fully comprehensive training session, but that could take days. So it's highlights and leading to broader development. So bear with us, and I'll stop me as I said before. So we'll start off with an introduction to the LGPS. I make no qualms about stealing this from Barney Rodingham. This is an overview of the LGPS. So it's a statutory national scheme, but it's locally administered. So there are 89, I think, local government pension schemes in England and Wales, which are run by upper-tier authorities named in the LGPS regulations. It is a defined benefit scheme, so members and employers paying contributions, and the benefit structure is defined in the regulations. So your pensions are guaranteed based on the length of service and your salary or the salary earned. It was a final salary scheme until March 2014, so basically your full pension would be determined on your final salary on leaving and the number of years service that you had. But from 2014 April, the scheme was changed to a career average. So benefits up to 2014 would be based on your final salary and the years accrued up to that date, and then going forward you would accrue an annual pension based on your salary, a proportion of your salary each year. There are protections in place, and I'm not planning to go into those at the moment because that's about a week and a half's training session, I would say. So we are working through that. It's a multi-employer scheme, so it involves the council and other Isle of Wight employers, and it's funded. So that means it's got its own pot of assets that we have to manage to be able to pay the benefits of the future benefits of our members. It's not reliant on the central government pot. So things like the teachers' pension scheme and the firefighters' pension scheme, police, judiciary, NHS are unfunded schemes. So effectively, the scheme manager collects the contributions from the members and the employers and pays the benefits out of that annual pot. And then at the end of each year, for the unfunded schemes, the difference between the amount collected and the amount paid out is either paid over to central government or recouped from central government for the unfunded schemes. For the funded scheme, the LGPS is the only funded scheme. We have our own set of pot of assets that we have to use, we have to manage, which is why we have an investment strategy and we have investment consultants to help us manage that investment pot to ensure that in the long run we have sufficient assets to pay all of our liabilities. It was contracted out until 2016. It's now contracted in. Again, another 3.5 day training session on GMP equalisation, but we will get there at some point. But Matt and his team have got this under control. Saying it's a statutory scheme, it's governed by primary legislation in the Finance Acts, the Pensions Acts, and most importantly, the Public Service Pensions Act 2013. And that is supplemented and introduced into law by the LGPS regulations. The most recent regulations in 2013 as amended, and they set out how the terms of law should be implemented through regulations. And that then is also supplemented by statutory guidance, which either comes through from the Government Actuaries Department or MHCLG, the Ministry for Housing, Communities and Local Government. There's a lot of stuff going on there. There's a lot of briefings that come round from various, the MHCLG, from the Scheme Advisory Board, from the Local Government Association, from our advisors, and that information is generally circulated to committee members in between meetings and then drawn to your attention at the meeting when it's to highlight the key issues. So there's a lot of information that flows around. I'll try and digest that as much as I can and then feed it on to you yourselves. But again, when you get those information, you can, I'm assuming you will read them, but if you have any questions, do just drop me a line, shout, and I'll try and explain them in a little bit more detail.
Which Secretary of State, who's the named person, I get lost between ministers and Secretaries of State, who is the actual Secretary of State for pensions?
Luke Hall is the Minister.
Sorry?
Luke Hall.
Luke Hall.
Is the Minister. Emma, is there anybody else? Emma on the spot.
I mean, you can see the confusion.
I think somebody was saying the other day, they've been with, since 2013, I think we're on our 7th Minister for the local government pension scheme. So it's fluid, shall we say. But this is why we have our advisors who support us in keeping us up to date with the legislation and making sure that we're aware of changes, as well as various networks that we belong to as officers and as a fund that we can share that information through. So the rules of the scheme are set out in national legislation and regulation, but the funds are locally administered. So as I say, there are 89, I think at 2019, 89 local government pension scheme funds in England and Wales, with total assets of £291 billion, ranging in size from the biggest, which I think is probably Greater Manchester, to the smallest at the far end, and the little red box is the Isle of Wight. So we were 87th out of 89 as at 31st of March 2019.
We were second from bottom, we're now third from bottom.
Yes, I think that's because one of the other schemes is closed. So it's no longer operating. So each of these 89 schemes, 89 funds rather, is operating their benefit structure and their administration and their governance standards in accordance with national guidelines, but is responsible for setting its own funding strategy and its own investment strategy to ensure that future benefits can be paid. I will go into the funding strategy and investment strategy in a little more detail later. So that's our local administration. We're the little red block in the corner. Don't think we're going to get much bigger, but we did win the Small Fund of the Year pension award in 2019. So it does prove that we don't have to be big to be good, which is really, really positive. Okay, so I move into the defined benefits. So as I stated earlier, the benefit regulations are set. Benefits are set in regulations. There are 3 effective schemes, and every time the regulations change, the LGPS freezes all membership as at that date, and then moves everybody from that new date onto the new scheme. So those members that have been employed by local authorities since before 1997 will 3 different tranches of membership and 3 different tranches of benefits. Each with a different accrual rate, each with a different lump sum commutation, and now with a career average calculation rather than a final salary basis. We will do a more detailed training session on benefit structures, but if you've got any questions about benefit structures, I'll refer you to Matthew and his team. Matthew knows everything. Matthew does it, and he does it really well. So, but we will talk in more detail, just to say that the benefits are structured in such a way that we work through to make sure that we can get that right information to the right people at the right time. So there are a number of statutory documents that are required for all funds to have, and we have all of these, and they're all published on the Pension Fund's dedicated website, which I will provide a link to so that you can see them. So we've got a governance compliance statement, which is published as part of our annual report and account. Sorry, I've got 2 pairs of glasses that I use to see, and I can't look at you and look at my screen with the same glasses on, so forgive me if I keep flipping about. The governance compliance statement basically forms an appendix to the annual report and account, and it sets out how the fund is governed, what its governance arrangements are, how frequently it meets, and how the fund complies with the guidance that's offered. That statement is quite a meaty document, and we update it every year. The last update was at October 2020, so we will be looking at whether we need to update it again for the 31st of March 21. That is going to be changing. The format of that will change as the governance arrangements change, which I will come to later on in the meeting. We have a funding strategy statement which sets out how we're going to fund the benefit contribution, the contributions and to fund our future benefits. So it sets out how we are going to set our contribution rates, what funding target we set so that we can afford all of those benefits, and it links very closely into our investment strategy. The funding strategy statement is reviewed after each triennial valuation, which is a formal valuation that's done by our actuaries, as the name suggests, every 3 years. The next one is due at 31st of March 2022, so there will be a lot of planning over the next 12 months to get prepared for that, and we'll get the actuaries either down or on screen to talk us through how that will work in due course. We also have a pensions administration strategy, which of the 6 statutory documents is currently the only one that is discretionary. It's not required by regulations, but it's suggested that most administrative authorities have them. We have got one, but the latest changes in the governance structure is proposing that the pensions administration strategy becomes a mandatory document. So ours is currently a little bit out of date, but we've decided that we'll live with it being out of date until we get the revised guidance that says what it needs to be in its mandatory form, because otherwise we'll be updating it and then we'll be updating it again. It's not significantly wrong, it just doesn't necessarily cover all of the things that the new strategy should do. The other strategies that we have is our communications policy, which sets out what we need to communicate to who and when we need to do it. We have a policy statement. We don't have a plan as yet to deliver that policy statement. We're working on that, but it always becomes overtaken by changes that are more kind of radical than how we communicate with our members, but it is something that we are actively considering. We have our investment strategy statements, which, as it says, sets out what investments we have, how we've considered the risk and return of those investments, and how they will fit with our funding strategy to ensure that we've got the right amount of money at the right time. It covers our social, environment and governance considerations in our risks and our investment strategy, and how we deal with our voting rights and our stock lending. The most recent investment strategy statement was out in 2021. It was approved in March 2021, following a significant review review following the last investment, the training valuation. We are looking at doing some investment training on the different asset classes we have. One of the questions I'll ask you later on today is to give you some dates when you're available so that we can get Emma to deliver that training. It's a very useful piece of training to explain how all of the asset classes work and how they fit into our strategy. And the last statutory document is the annual report, which basically contains the accounts and various statutory required statements from our actuarial colleagues, our investment advisors, the administration report, risk register, etc., etc. It's about 141 pages long, and when you contain all of the documents in it, how many people read it? Probably, I hope all of the committee members read it when it's published. Joe and I read it in great detail. And that's probably it. It goes on the website and never gets looked at again. So, as I said, at the end of the slides, there is a link to the council's website. It's a pension fund website, and all of these documents are on there, and I would invite you to browse them at your leisure. We won't be tested at the end of today, but you might be at a later date. So, how the fund works. As I said, we're a funded scheme, so we've got a pot of assets, the bit in the middle, that funds all of our benefits, so whichever screen you want to look at. And so the income coming in is our investment returns, our member contributions and our employer contributions, and going out on the other side is the benefits to the members. So what we need to make sure is that there is enough money in the pot in the middle to pay the benefits as they become due. So by colour coding, the investment returns are determined by the investment strategy and our managed performance, and the contributions, member contributions are set by regulation, and the employer contributions are the balancing figure that's set at each triennial valuation to make sure that in the long run we have sufficient money to pay all of our benefits.
Thank you, Joe. Just a question. Is there any kind of percentage that you would be looking for the employer contributions to balance off? So obviously I know that we look at a certain return from our investments. Member contributions, as you said, is a statutory figure, so that can be quite easily calculated.
Yeah.
So the employer contribution being the balance, what kind of sort of percentage would we consider to be acceptable?
That is determined each year by our actuarial advisors as part of the training evaluation. And it's kind of a bit black magic-y, but it's not really. When we come to the training evaluation, and that will be part of our first training sessions in the first year, because we've obviously got evaluation as at the 31st of March 22. Effectively, what we look at, what the actuaries look at, is they look at a variety of scenarios, working with the investment consultants to say what is our investment strategy now, what is the expected return from that, we kind of know we know our membership structure as at the 31st of March, so what we look at then, what the actuaries look at is the longevity, so how long are people going to live, how long are our benefits going to be paid for with our active members, our deferred members, and our pensioners, how much is that pot going to be, and therefore, how much money do we need to have in that balancing contribution. Then they look at how much, we target 100% funding, so we target that over a 20-year period, I think 20-year recovery period, we will be 100% funded. So they run around 5,000 scenarios on different investment returns and different contribution strategies to come up with a 75% certainty of, in 75% cases, we will be 100% funded, and that is then how the contribution rate is determined. In a brief nutshell.
Sorry, I think my question is the actuaries, how would they determine it's about the risk factor?
Yeah.
So would they, that 75% of scenarios, would they look at that and actually say that's a high risk strategy? I'm sorry if I didn't make myself clear.
No, absolutely. The actuaries will recommend to the pension fund what the strategy should be, and they will look at then that they will make recommendations to you. There will be, just to reassure you, there will be more in-depth training on the valuation, and there's a bit more information on it coming up shortly. And then they assess for the contribution rates for the next 3 years. And then in 3 years' time, they'll review it again and set the contribution rates for the next 3 years. So it's not fixed forever, the contribution rate. They will assess with reasonable certainty that the risk is acceptable to the actuaries and to the fund. And then they will discuss with each of the individual employers within the fund the acceptability and affordability of that contribution rate for the employer before they are set in stone. But they will then be reported back to the committee, and the committee approves the final valuation strategy.
Thank you. That's answering.
Yes.
When will the next valuation actually be done? Because we now have a situation where people who join the council are automatically, am I correct, go into the pension scheme, and they actually have to sign an agreement to withdraw if they don't want to belong to it, which is the reverse of what had happened in the past. Before, it was voluntary. Now you join and then you have to drop out. How has that affected us as a council? That's the first question. Secondly, if everybody in the council joined the scheme, what would be the balance between the money coming in and the possible outlay for pensions at a future date?
Okay. Let me try and get some of these questions in. The next triennial valuation is at March 22.
Right.
So we were starting to plan the data reviews and data collections at this time, and over the summer periods, and definitely probably in November, the November committee, we will have presentations from the actuaries on the assumption setting, etc., how that will go through. So there will be training in more depth between now and November. In terms of automatic enrolment, you're absolutely right, Vanessa. Everybody that joins the council as a new employee, I don't mean councillors at the moment, is employees are automatically enrolled into the pension fund, and then they have a period in which they can opt out, and then their contributions are returned. But they have to have, and we have to carry out an automatic re-enrolment every 3 years.
3 years, so the next one is 2022.
In 2022. So in March, on the 1st of April 2022, everybody that is employed by the Isle of Wight Council and the schools is automatically re-enrolled in the pension fund, whether they've opted out previously or not, unless they joined in the last 12 months, in which case they don't have to opt out. They have a month's contribution taken, because that's the automatic enrolment requirements, and then they can opt out and have that returned. Our opt-out is relatively low.
It is quite low, yeah.
So we've got the vast majority of our members of staff are in the pension fund, but there are levels of assumption made in the actuarial valuation about the staff turnover, so those people that are leaving, those people that are joining. We assume everybody comes in. We assume that there is a standard amount of the standard life expectancy after you retire. There's an average age of retirement. There's an average, all of this sort of stuff, which the actuaries will go into in great detail. And they do a lot of work behind the scenes, and the valuation is based on our population statistics, so our membership profile, It's not the average of all LGPS members, it is the Isle of Wight Pension Fund membership profile. And they will assess longevity, they'll have a look at how we think it's going to go, and they will base the contribution rate and the investment returns and all of that sort of stuff on our population. In terms of the income compared to expenditure, I've got a slide on that coming up towards the end. So you'll see that we're slightly cash flow negative in terms of contributions compared to benefits, but when you look at our investment income, we're cash flow positive. So we've got sufficient money to be able to do that, but that goes into more detail going forward. Does that make sense so far?
Just one other question. I remember from the last committee, people didn't really understand what an actuary did. Will we have a short session just to say to people, well, this is what the actuary actually does? Because the general public have no idea. They hear the word and haven't got a clue.
Yeah.
It would be interesting to know the thought process that they go through, the information they collect, etc.
Yeah, we'll have the lovely Craig at some point come down to give us or be connected. And I apologise, lovely Craig is probably a sexist comment, but he is lovely. Sorry, Joe. So that's how the money comes into the pot and that's how the money goes out. So as I said, contributions are set for employees, for the members in regulations, ranging from 5.5% of salary for the level paid members of staff and up to 12.5% for those people that are on significant amounts of money. And if you're a part-time member of staff, your contribution rate is based on the full-time equivalent salary. So you would, if you were part-time and your full-time equivalent salary was £47,500, you pay 8.5%. And then the employer's contributions are set by the actuary, and as I say, they're set every 3 years. So they're fixed for a 3-year period, then we carry out the next actuarial review, they set contribution rates for the next 3-year period, we carry out a review every 3 years. So it's not a historic one-size-fits-all, it's regularly reviewed and the risks are assessed on a regular basis. For the Isle of Wight Council, for the current actuarial evaluation, as at March 19, the contribution rate is 23.5% of payroll. So the member contribution ranges between 5.5% and 12.5%, and the employer contribution is 23.5%. So that's the overall overview of the LGPS. I'll just go into who is who now on the Isle of Wight Council Pension Fund. So, the Isle of Wight Council is the administering authority as set out under the LGPS regulations that state that all upper tier authorities have to maintain a pension fund for their employees. The scheme manager, which is a new term that was introduced in the Public Service Pensions Act 2013, the functions of the scheme manager are effectively to manage the scheme, and it is the Isle of Wight Council has delegated that to the Pension Fund Committee. So the Pension Fund Committee is the scheme manager, and the scheme manager's role is explained on the next slide. The pension fund has the same Section 151 officer as the local authority, so that's Chris Ward. I'm sure you've met him, seen him. If you haven't, you will do. I'm the technical finance manager, and my role covers at the moment pension fund, treasury management, and VAT. Because I'm lucky like that. ably supported and very well supported by my colleague Jo, who's pension fund and treasury management accountant, and her role is pension fund, treasury management, and VAT. You have the pensions manager, Matthew, as we introduced previously, runs the administration team. Democratic support officer is Megan, and she's marvellous. And we also have a local pension board, which was created as a critical friend scrutiny function under the local government, under the Pension Public Services Pensions Act of 2013. members of the pension board have been invited to these meetings and are not sitting in that down at the back. So the pension fund committee as scheme manager is a locally agreed role, but it has to carry out the functions of scheme managers as to manage the scheme on behalf of the members. The terms of reference for the pension fund committee are set out in the council's constitution, and when you, as elected members, sit on the pension fund committee, you are running the pension fund. You are not sitting here as councillor for Sandown, for example. You are sitting here as a nominee from the council to run its pension fund. So when we talk about the valuation in particular, you will be focusing on how the valuation works for the pension fund. So whether the contribution rates that are being set are suitable to ensure that the pension fund is fully funded. You will have a mind on the fact that you are also running the Isle of Wight Council, but when you sit in this room, you're looking at the affordability and the benefit for the pension fund. When you go to Cabinet or to full council and you're setting the budget, you will need to be looking at whether those are affordable for the council. But you have to remember the brick wall between, in your head, Isle of Wight councillor and pension fund committee member. But we will go through that, and we have interesting conversations. Chris Ward, as Section 151 officer, has to decide, listen to me sitting on this side as a pension fund and telling me you need to pay in more money, and listen to Kerry Holiday on the other side saying, as a council, you need to pay less money. And so we argue with ourselves and eventually come to an agreement. So that's how the pension fund committee works. And then the local pension board, as I say, was created under the Public Services Pensions Act 2013 and is prescribed in regulations to assist the administering authority in securing compliance with legislation, etc., and assure effective and efficient governance and administration. So it's not that they do the governance and administration. That's the pension fund committee's responsibility. They will ensure that the decisions that are made in the pension fund committee are made in accordance with our policies and our processes and in accordance with regulation, that all aspects of the standards for governance are being complied with, and they will also do some more in-depth work in looking at data quality and key performance indicators and membership statistics, etc. And there will be a report from the pension board to the pension fund committee on the work that they have done at every meeting, and the committee can then decide to perhaps commission work from the board or ask the board to do more in-depth work and then report back. The committee is the decision-making body. The board is the scrutiny, the critical friend, the support and assistance to ensure proper standards of governance and administration. The membership of the pension board is prescribed in regulation and in law that says they have to have an equal number of employer and scheme member representatives and a minimum membership of 4, which is 2 and 2. We currently have 2 and 2, but we are looking at increasing that membership to 3 plus 3, plus bringing in an independent chair to support and administer the board. The only rule is that the members of the pension fund committee and anyone as an officer that is involved in pension decision making cannot sit on the board, because you can't scrutinise yourself and challenge yourself. Which is why we are at the moment in a little bit of a situation where the nomination that came through at full council for the pension board member was the chairman of the pension fund committee, and obviously that is unacceptable, so we've had to defer that until next full council meeting. There will be more training on the roles of the pension board and the pension fund committee, and we will have input from the board into those roles.
Could I just say, for obviously the 2 new members, the pension board cannot influence how the funds are put about and spent. The pension board is really, it's almost like a police watchdog, isn't it? is to make sure that all the due processes that we as a council use are adhered to and put in place. But it cannot influence the pension committee's decisions about where the money, how the money is put into investments. Because last year it got slightly confused. So I just wanted to make the point that there is a very clear distinction. They are a watchdog. Would you agree, Jo?
They are, but what they will look at is to ensure that all factors are considered when decisions are made. So, for example, if, and as members will be aware, climate change is a big issue at the moment, and there is a lot more requirement on pension funds to take account of climate change and other environmental factors in their investment strategy. And our investment strategy statement should have a good statement on what our ESG, environment, social governance considerations are, and our responsible investment responsibilities. And if that, the board will look at that and say, does what we've got meet the requirements of the regulations or the guidance? If it doesn't, they can challenge the committee and say, you need to put more thought into this. But what they can't do is say, this investment that you've agreed, for example, doesn't have enough or has too much fossil fuel in it, you must disinvest. What they can say is, why have you considered that this is suitable, given that it is? Have you considered the fact that this has got a lot of fossil fuels in it? What was the rationale behind that decision? Have you taken into account all of those factors? Yes, fine, move on. But not, you must disinvest from fossil fuels, if you see what I mean. So it's kind of, has the committee made the decisions based on all the facts, and have they considered all of the aspects of the decision-making process? So they can't direct what we do, but they can make sure that we have considered everything when we made that decision. Does that make sense? Okay. So we don't do all of this ourselves. I like to take a lot of credit for doing everything, but I don't. And I have to rely on a lot of people to do this. And this is where the Emma and her colleagues come in. So we have actuarial advisors who are Heinz Robertson. We have investment consultants who are also Heinz Robertson. And we have governance advisors who are also Heinz Robertson. But each of those three different advisors have been procured through different procurement contracts. Coincidentally, fortunately, they all come out as Heinz, but they might not be. We've had Heinz as our actuaries for a very long time, but they are periodically replaced or reviewed and recontracted. The investment consultants until 2018, I think, were Mercers, but we did a re-procurement activity and Heinz came out on top at that time. We have a schedule of re-procurement activities that we need to carry out over the next 4-year term. That's factored into my work plan beyond this 12 months, fortunately, so I don't have to worry about them yet. But we will be looking at using a national procurement framework to reassess the market, reassess the service requirements, and re-procure those activities to ensure best value for money for the pension fund. We have a custodian, which is Northern Trust, and again that is procured on a regular basis. The custodian is responsible for holding our assets, so they look after the investment assets on our behalf. We don't have the share certificates, we don't hold the stocks. The stocks are held in our name, but they are managed and held in secure locations by the custodian. So they report to us on the valuation of our assets that is supported by the fund manager that reports to them. So we use the custodian to keep our assets safe, and they provide us with all of the reporting that we need. We will have a development session on what a custodian does, because they probably do more than that, but basically they keep our assets safe and safeguarded on our behalf. We are part of an access pool, or an investment pool, which is Access, which I'll talk about in a bit more detail. Effectively, regulations in 2015 determined that the LGPS could get better value for money in its investment manager fees by having larger investments. So if you imagine, as I said before, we've got £600 million worth of assets. We don't put all of that in one pot. We spread that out across various investment managers. So our investment funds, effectively our individual portfolios, are really quite small in the overall scheme of things. 5% of our fund is £30 million. £30 million for one of these investment managers is quite a very small investment, so we would be charged quite a high level of investment fees because they're looking after a small amount of money for us. The advantage of pooling and putting money into a bigger pot combined with other pension funds, still our money, but we're jointly investing it with other funds, is that those investment values creep up, and so the fee structure gets less and less of a percentage because they've got better value, they're better economies of scale as a fund manager. So we have benefited quite significantly from being part of the investment pool because our investment manager fees are shrinking, which is what was supposed to happen. Again, there will be a fuller training session on the investment pooling, and later on I've also got some more slides as to who is in the access pool and what the access pool, how it was set up. And then behind the scenes as well, we have our fund managers who invest the money on our behalf. So we've got Schroders who run our fixed income and property portfolio, our equities, global and UK, and our diversified growth are within the pool, so those are run in the access pool. We've just implemented a private debt portfolio in January with Goldman Sachs, and we are just in the process of onboarding a infrastructure investment with Partners Group and switching some of our active investment management and equities into passive with UBS. We have an investment asset class training session scheduled, at which point we explain what all of those do, what they are, and how they work. But at the moment we have a balanced portfolio as advised by our investment consultants, and Emma will talk you through in a bit more detail later. Where am I? Summary facts and figures for the Isle of Wight Council Pension Fund. This is unaudited figures at March 21. Starting at the bottom, we've got active members, deferred members and pensioners, and I'll talk about those in a bit more detail, but we've got about 16,700 members of the pension fund across our active, deferred and pensioners. So active members are those that are currently employed and paying contributions to the pension fund. Pensioners are, as they say, people that have reached retirement age and are drawing benefit. That also includes spouses and survivor pensions and children's pensions for those survivors of those pensions that died. And then we have deferred members. So deferred members are those people that have been employed by the Isle of Wight Council and the other employers within the fund, but have left employment before they've reached pension age. So they're entitled to a benefit when they reach pension age, but not yet. So it'll be you. Yes, indeed. So Claire will be a deferred member of the Isle of Wight Pension Fund. So you get a statement every year that says this is the value. When you get to 65, 67, whatever your retirement age is, you will get this benefit from the fund. So 16,700 members, that's over 10% of the Isle of Wight Council, of the Isle of Wight population, has an interest in the Isle of Wight Pension Fund. So it's not big, it's not sexy, it's not children's, it's not adults, it's not roads, it's not waste, it's not environment, but it's 10% of the population. Okay. There are 30. Just really on. I sometimes struggle to get people to elected members, officers, to realise that the pension fund is important.
Significant.
So I just throw that over 10% in, just to say, we are important. Please take me seriously. There are 32 employers within the pension fund. That's the Isle of Wight Council and 31 others. I'll talk to you more about those in a minute. Annual contributions, employees and employers, we received £20.3 million last year in contributions, and we paid out £22.3 million in benefits last year. Our total investment assets of £695 million as at the 31st of March, and our investment liabilities are £670 million. So our pension liabilities are more or less funded. We had a return on our investments of £119 million last year. Do not expect that every year. March 2020 was severely impacted by the COVID pandemic on the investment markets, but they have more than bounced back. So we've made quite a significant chunk of our money back this year. It's taking us up to the biggest investment value that we've had in memory this year of £690 million, and our pensions administration is done in-house. So that's the pension fund in a nutshell. I'm going to skip over that bit. So we've got, I mentioned it's a multi-employer scheme. So we've got the administering authority, so the Isle of Wight Council as the biggest employer within the pension fund. Then there's different types of bodies that are also entitled to be in the pension fund. Scheduled bodies. Scheduled bodies are defined in the Schedule 2 of the LGPS regulations. Part 1 is those employers that have to employ, have to enrol their staff, eligible staff, into the LGPS. So at the moment that's the academies and further education colleges relating to the Isle of Wight Council. So the Isle of Wight College and the various academies on the island are scheduled bodies. The second part of scheduled bodies is those called designating employers, and those are employers that are entitled to enrol their staff into the LGPS under regulations, but don't have to. They can choose which members of their staff come in. So at the moment, our town and parish councils are designated bodies. So not all of our town and parish councils have members of staff in the LGPS, but some do. I guess any employer, any town and parish council could put their clerk, for example, into the fund, but it is, as we've said, quite an expensive scheme. It's a very good benefit structure, but it is quite an expensive scheme to the employer. And the town and parish councils pay the same employer contribution as the Isle of Wight Council, so 23.5%. And then you've got the admission bodies, which are those bodies that are not automatically entitled to come into the fund, but have an outsourcing relationship from the council or from the scheduled bodies, and therefore have the right to retain their benefits in. So the transferee admission bodies are things like Island Roads, where staff are outsourced from to the High Risk PFI, Bernardo's for the early help contract, things like Caterlink, where Cows Enterprise College outsourced its catering, and finds, I think, at the time, members of staff transferred across to the new catering supplier, having previously been employed by the college, by the Enterprise College, as members of the LGPS. So we've created an admission agreement for them, and they can remain in the scheme. They have their own contribution rate, etc., etc. We will talk about employers in more detail at a further training session. It's going to be a bit of a repetitive thing. We also have some community admission bodies, and we've got some historic organisations that are not necessarily linked to the council, or weren't driven from the council, but had in olden days, back in the day, a kind of community public service type role. So our community admission bodies are Yarmouth Harbour Commissioners, Cowes Harbour Commissioners, and Carisbrooke Castle Museum. I think the admission agreements I've got date from about 1960, 1970 for those, and they again are treated as separate employees. They've got their own profit assets, they've got their own liabilities. So those are the employers. We'll look at the membership numbers in a moment. I'll skip through the slides, there's a lot of background in there. But if you look at the membership numbers, we've got one administering authority, which is the Isle of Wight Council, 16 scheduled bodies, and 15 admitted bodies. The admitted bodies, 15 admitted bodies have 400 members across all schemes, across all classes of membership. The 16 scheduled bodies have 1,600 members, and the Isle of Wight Council has 14,650. So the 16 and the 15, the 31 other employers account for 15% of the membership of the fund. But we have to administer that, we have to maintain the data, we have to administer their accounts, the accounting side of the pension fund, we have to provide their members with benefit statements, we have to provide their members with benefits, etc., etc. So it is a multi-employer. We will go into more detail as to how the administration system works and how we collect contributions and how we pay the benefits, all of that sort of thing in another system. But that's the context of 16,700 members, all of which active members are Ireland employees. The pension members, I think it's about over 95%, I think, of our pension members, maybe even 97% of our pension members live on the Isle of Wight, so are contributing to the island economy. And the deferred members are mostly...
We pay over about 1.8 million a month in pension payroll. So if you think about that money coming into the Isle of Wight economy, it's quite a large amount.
Any questions on employers, members at the moment? Okay. I think I'm over halfway. Investment strategy statement, we spoke about that. That's how we set out our investments, what we do. There's a link to the published document. We've got our investment assets. There's a detailed report in your pack, and Emma, after I've done this blurb, Emma will give you a more in-depth view of our investments and what we've got, why we've got them, who we've got them with, and how they've performed. But you can see that our allocation is spread across equities, diversified growth, property, private debt, and fixed income to give our investment strategy. I'm not going to go into the why of the pool, but we've kind of spoken about. I'll do a bit more detail on that. But we are one of 11 funds in the access pool, combined with all of those authorities. As at the 31st of March 21, I think the estimated value of the access pool is £50 billion of combined assets, 508 billion. We're 690 million of that. Small but very important. We have an equal share in governance. We have one fund, one vote, and we have the same rights as Hampshire, who are 12 times more larger than us in terms of investment on assets under management. The access pool is run through a joint committee, so the chairman of the pension fund committee, Chris Drummond, will be attending the joint committee. Previously, Vanessa has attended that and interacted with the other 10 funds and made the decisions, etc., etc. The officers, there's a Section 151 officers group, there's an officer working group which I primarily attend and Joe attends in terms of reporting and some of the other investment stuff. There's a support unit, and the funds are held and managed through Link Fund Solutions as our operator. So they hold the investments, they run the investment managers on our behalf. Again, another investment training session will be carried out on that. So it's £55.1 billion, of which we have 73% of our investments are within the asset pool. We have plans to put the others in once effective solutions are provided within the pool. That's a whistle stop tour of access. I think we've covered previously the fund valuation, how we do it, why we do it, what it does, and we will do a more detailed investment and actuarial valuation. The valuation of the whole fund was carried out and presented to the Pension Fund Committee in 2019, and the valuation report is on the Pension Fund website with the link there. The valuation of a single member, so each member that we look at has various stages. So they've got their active life where they pay their contributions in, then they reach retirement and they're entitled to a pension lump sum as part of their benefit structure. Then we will pay a pension for them until they die. And then if their spouse, surviving spouse or partner will get a pension until they pass away. And for their children, if their children are under 18 or under 23, if they're in full-time education, then they will get a dependent benefit. So you can see, if we recruit somebody at age 20, we could be paying pension, we could have a relationship with the pension fund for 60, 80 years, depending on their thing. Anecdotally, the last American Civil War pension was paid recently. In June 2020, the last child of an American Civil War veteran passed away. So that's in 2020, and the member started paying into the pension in 1885. So that's what, 160 years, 150 years of relationship with the pension fund. I don't think ours is going to be that excessive, but, it's a long relationship. And the typical fund benefit profile, which is what the actuaries will look at, is to say, how long is this relationship? So on that screen, you've got the green bars, which are our current pensioners. So we know that our current pensioners, on average, I think at the last valuation, was 71 years old. So based on average life expectancy, we will stop paying them within 40 years-ish. So some of them could be 55, some of them could be 90. Our deferred members, we're not really paying any benefits for them at the moment because they're deferred, but they will be, so their tail is slightly further pushed out. And our active members, some of whom will be close to retirement, but others of whom will be recruited yesterday, will have a long tail. So it is a long-term relationship. We're looking at possibly 90 odd years of relationship with each member until the last of our pension funds are paid, assuming we get our active members. But we will be getting active members, so that relationship will never cease. Again, we'll go into more detail, but it's just a demonstration of the cash flows potentially for our fund benefits. The funding strategy statement then summarises how the fund is funded, and that's again on the website, and we'll do more training on that in more detail. The governance Bible, I haven't actually got my copy with me, but I do have the consultation on the new code of practice from the pensions regulator. So this is the new code of practice that's currently being consulted on. It's big, 51 modules, most of which apply to the LGPS, 12 are new this year compared to what was in that. It's not quite law yet, it's being consulted on, consultation finished last week. We expect it to come into force this calendar year, and then funds will have 12 months to comply and demonstrate that they'll comply. There's also been a good governance report, which I do have with me, which was carried out by the Scheme Advisory Board, so the National Scheme Advisory Board that supports the LGPS nationally and the funds individually. This sets out improvements to standards in governance, primarily in terms of consolidating governance guidance that's out there, which currently ranges from about 1996 through to 2020, in different forms of guidance, and the MHCLG guidance, SIPFA guidance, Scheme Advisory Board guidance, pensions regulator guidance. So they're looking at consolidating those into a standard of good governance. We've commissioned a gap analysis review from our governance consultants to look at where we are currently in terms of our governance framework and where we need to be to get to this standard, which also mirrors this code of practice. That should be coming through. We've commissioned that work, and it will come back to us to identify what we need to do to become compliant with this before it becomes into law, and then we'll be on a good place to have an action plan to get us to where we need to be. That's the whistle-stop tour of governance. Your part of the governance framework. A lot of the governance documents are on the national on our fund website, so you'll be able to see those, and I'll talk you through them in more detail. Challenge. What do you need to know as pension fund committee members to be able to do your job? In legislation, nothing. There is no statutory requirement for you to know anything. But you need to make decisions on £690 million worth of investments for 10% of the pensions, the island's population. So you need to know these pieces of information. You need to know basics, you need to know enough to be able to make informed decisions and make good decisions. I'm not going to get you to do them all today. I'm not going to talk you through all of them today. I'm going to give you 6 months to get a basic knowledge, but we will supplement that. So what we've got is there is a pensions regulator toolkit. So the pensions regulator toolkit has 7 modules, I think, that cover those topics that we're there for. There are 30-minute modules, which is online learning, online reading, and then a multiple choice quiz at the end to see whether you've understood what's there. You get a certificate at the end of that to say that you've passed those 7 modules. That's the minimum. That gives you the basics of the local public service pension schemes, mostly relevant to the LGPS, totally not specific to the Isle of Wight Council Pension Fund. So that will give you a top level view. Hyman's are just launching their LGPS Online Learning Academy, or LOLA as it is called. I have a demonstration of that on Friday this week. And that again is online learning, bite-sized between 7 and 23 minutes, I think, of those modules, which again will give you further insight into the different aspects of the LGPS. Again, you can get a certificate out of that. So we've got 2 pieces of paper that we can have for you that shows that you have a basic understanding. And then we've got development sessions, there's national and regional events. We'll have our investment managers, we'll have our fund advisors come down, and we will deliver you training sessions. There is an LGA fundamentals training programme coming up 3 days, in person or virtual, in 1 day in October, 1 day in November, 1 day in December. We did that last year, didn't we, or the year before last? 1 day, and it's actually really good. It's designed by the Local Government Association and it is specific to the LGPS. There is a cost to it, but it's really worth doing. So I will send you a link through to let you know more information and actual dates of it, and if you want to sign up for it, please do. Again, you get a certificate at the end of it. I keep banging on about certificate, but it's evidencing your knowledge and understanding. There's a pensions network from SIPFA, which is run on an annual conference. We haven't got the dates for those yet, but I'm sure that will come around. I generally attend those if I can, because it's really good networking, but it also brings you up to date with their really good national speakers and bring you up to date with current activities. Hyman's do a periodic keeping the LGPS connected. I think they're up to, they've been running this since March 2020 during the pandemic. I think it's every 3 weeks. It's a half an hour bite-sized session where they have a relevant speaker talking about a relevant issue. Chatham House rules, not recorded, but it's just useful to understand what's happening. I'll send through invitations to those as they come around, and you can sign up as you want to. And others come through externally as well. We have a lot of things that I've already said to you today. There will be a more in-depth session on this. There will be a more in-depth session on this. What I'm planning to do and hoping to do is to do these outside of the committee sessions, committee meetings, as 1.5 hour virtual sessions on Teams. So you can come in, do the ones that you need to or not, but not have to commit to coming into County Hall, sitting here face to face, and we'll record those if you can have them available. So those are the sort of things that we want to do. And the first one will be the investment asset classes from Emma, and a report on our ESG RI carbon footprinting of our baseline portfolio, so we can see where we stand at the moment and what we need to do to improve and comply with the Task Force for Climate Change related financial disclosures, I think. Requirements that we need to disclose. So I will be circulating after those dates, either the week of the 28th of June or the 14th to the 16th of June are dates that are convenient for Emma to be able to deliver those trainings. So we'll try and find a slot in your busy diaries for an hour and a half in an afternoon where you can attend a team session in the comfort of your own home to get that, and I'll find a suitable time. And then we'll look at when is a good day for you guys to have virtual training sessions on a regular basis. Not trying to overwhelm you, but just trying to bring you up to speed, because as you gathered from this huge agenda today, it's a big project. There's a lot of things for you to learn. So we're planning on 4 committee meetings a year in May, July, November and February. And the reasons that they're in those months is because the quarter end is obviously March, June, etc. Can't work that out in my head. And we need to have some time to get the quarter end investment performance to you. But there are also in July, in a normal year, we will be presenting you with the annual report and accounts for approval. In February, we'll be presenting you with the budget and work plan for the next 12 months. And so we'll be looking at various activities. In your agenda, there should have been a work plan, but I think the file corrupted, but I'll put one on your desk so you can see the sort of things that we'll be looking at in the pension fund committee meetings over the next 12 months. And on the back page of that agenda, there's a list of the things that I think, of the work plan, there's a list of things that I think are the key areas that we need to have training sessions on. They're in alphabetical order, they're not in an order of priority. Just because I didn't want to muddle myself up, so I thought put them in alphabetical order and then it's done. There is an expectation that members will attend every meeting, and there's an expectation that you will attend where possible every development session, and you will commit to taking time to do that development. And it does get reported in the annual report of the pension fund as part of our compliance statements. So, my last slide. Thank you. I'm really sorry. It is the last one. That's a lot of information. I would not be surprised if your mind is blown and you have a headache and you would walk out and think, why on earth did I sign up for this? But please do that next time, because it is really important. As I say, whistle-stop tour, lots to take in. Please call me, please email me. I'm really happy to sit down and chat with you. I can call on our advisors, Matt, Joe, myself. We're always happy to take your questions. There is no such thing as a draft question. Most of the time I know the answers. If I don't know it straight away, I can find out for you. But I am here to support you in making your decisions and running this pension fund for 10% of the island's population. So just shout when you can. Thank you.
Can I just say sorry to the new members that when I first joined pension committee, Joe actually did a one-to-one with me, and it was absolutely brilliant. So I would recommend you take her up on that.
Thank you. So that's me done.
Good. Thank you, Joe. Some members of our council think pensions is boring. I think it's the most interesting committee in the whole council, because you really do get a vision of what's going on in the rest of the world. And when you have people like Emma and some of the fund managers telling you how the rest of the world is and lives, personally I find it fascinating. So I hope new members will feel the same. It is a big learning curve, isn't it, Joe? And as I've pointed out to fund managers many times, we do this as councillors once a week, once a month. And I'm always on at them saying, please keep it simple, please keep it simple. Because otherwise, they think they're talking to people on their own level. And unless you're involved in pensions day by day, it is difficult sometimes to understand. But Joe is an excellent officer, always smiling, always helpful, and Hymans Robertson really are brilliant. We've just renewed their contract, I might add, I'm not sure how long it lasts for, Joe.
Well, I'll build that into the work plan. When we come back, I'll give you more information on the context. I didn't want to overwhelm you today.
So, as I said, you know, it is a question of perseverance to start with, but it gradually falls into place. Thank you, Joe, for the presentation.
Can I just say, I'm really sorry, in your pack you've got this introduction to the LGPS, which is a brief overview from Heinz Robertson about what the LGPS is. It gives you a little bit more information, it will probably provide you with more questions. And the other thing that you've got in there is a copy of the pension funds objectives set in 2018-19, which sets out how the committee at the time felt around governance, administration, investments and responsible investment. We will be looking at these in more detail as we go through the various sessions, and we will be updating those objectives to make sure that they're still reviewing them to make sure they're still fit for purpose, and we may need to update some of them, but they will be basically the information as to why we do what we do the way we do it effectively. So again, have a read through, look at what you've asked any questions and just bombard me. I'm happy to be bombarded. Graceful swan, glamorous, don't need to see what's underneath it.
Could I ask, Emma, is there anything that you wanted to add before we finish?
No, I think I can cover all of my section. I think this was a very excellent job in an hour and a half to cover the entirety of the LGPS.
Still got items on the agenda.
Sorry?
We're still going to the agenda.
Yes, but I just want to see if Emma wanted to add anything else. So we're now on to the draft financial.
No. We're on item 5.
Item 5,
Sorry, item 5, investment position.
Which is
Sorry,
handed
going down
down.
too fast. Before we start this, does anybody want a comfort break? It's 11:30. No, fine. In which case?
1 minute, 2 minutes.
Yep, right, okay.
I think that's a yes then.
If literally 5 minutes, if we're back just before 12:30.
A brief overview of your investments, your investment strategy and the standard quarterly report that you would come to see at these pension committees is produced by us. But for a brief introduction, I am Emma Garrett. I am an actuary and investment consultant. I've been an investment consultant to Isle of Wight Fund ever since we were appointed in 2018, and I've been at Heinz Robertson for 6 years. And I advise a wide portfolio of big LGPS clients as well as private sector clients as well. I am going to just quickly flip on to the report that's in your pack, which is item 5, your investment performance monitoring report. And I'll give you a brief background on markets and what's happened in markets over the quarter and from the end of the quarter to date. And then I'll run through quickly the fund's investment strategy, the types of things you've invested in, and the performance of your fund to date. Okay, before I start, did anyone get any questions? So over the quarter, over Q1, so from January, February, March, the outlook for global economic growth has continued to improve. So it was up 5% over Q1, and that was against an overall contraction of markets that we saw across 2020 as a whole. So over 2020, we saw the global economy shrink, but in the quarter 1 year to date, we have seen the economy boom, and that's mainly because of the contractions we saw at the end of the year. Things are starting to recover. Vaccine rollout programs are progressing, and big central banks like the US Federal Reserve or the European central banks or the Bank of England are still pumping money into the economy, trying to support major developed economies and bringing that global growth back to what it was before the crisis that we saw from COVID-19. When we talk about equities, we mean just stocks and shares. So we talk about global equities, companies from all over the world, in US, Europe, emerging markets. And we also talk about UK equities, so those are companies that are based within the UK. Global equities over the period for Q1 were up in local currency terms, they're up 6%. And there is currency impact on returns that you get from overseas, and when UK sterling strengthens, that negatively impacts on the amounts you're getting overseas investments. So once we strip back the impact of that sterling strengthening, global equities returned around 4%. And really it's the leading area of returns within global equities were the energy and materials sectors. And that's quite typical of an environment that is high growth. So as everything starts to open back up and manufacturing starts to regain momentum, we'll see things like energy, oil and gas and material sectors outperforming. Whereas when we saw the economy contract last year, we saw things like technology stocks outperforming the rest of the sectors. And that's just cyclical depending on what part of the economic cycle we tend to be in at any one time. So economy is recovering and people are more optimistic over the outlook of global growth over the year, and that's reflected in more money getting pumped into the economy and more money getting moving away from less risky assets into more risky assets such as stocks and shares, and that's why the prices of them are getting boosted up. People are getting confident in the markets again and putting money into those assets which are driving prices upwards. Global stocks and shares have outperformed UK stocks and shares, and that's quite a long-running theme now. It's been that way for a number of years. And UK equities still underperformed, despite the UK economy having quite a high allocation to things like oil and gas. It still underperformed relative to the rest of the world. And just as a reminder, over half of the fund's total investment, so your big pot of cash that's invested, half of that is within stocks and shares across the world. You've got a high allocation to UK, but you also have a high allocation to the rest of the world, mainly in the US and Europe. Equities have kept climbing, so Joe mentioned that they fell significantly at the beginning of last year in the wake of the pandemic, which is true, but they have recovered all of that lost ground and more since then, which means that the value of those stocks and shares actually looks quite expensive relative to historic measures. So we will expect that growth that we've seen over the past year to slow down over the next 12 months or even contract as the economy starts to balance back out. So as Joe said, we have seen stellar returns since March last year from the bottom of the pandemic to now. We would not expect to see that level of return again over the next year. So stocks and shares have done well. Another major type of investment that you have within your fund is to bonds, and those are just different types of loans. So you can loan money as a pension fund to governments, or you can loan money to corporations or companies, and they will pay you back interest and then eventually the full balance of that loan as well. And bonds in this environment tend to be seen as less risky than stocks and shares, and that's because they rank higher than shares within the corporate structure of a company. So if something goes wrong, the company will have to pay back your bonds first, and then you'll pay the shares back if there's any money left in the pot. So because bonds rank higher, they tend to be seen as less risky, and therefore the amount of return you get in a bond is lower than that of stocks and shares. So we see stocks and shares as risky but high growth. They generate a high level of return to help you fund your pension scheme, to give you that investment return to help keep your employer contributions as low as possible. Then we invest in bonds, and we invest in corporate bonds, which is lending money to companies, and we invest in government bonds, which is lending money to governments. And when we talk about lending money to governments, we buy something called gilts, which is just UK government bonds. And the purpose of that allocation within your investment strategy is to provide stability to your funding position. So they're less risky, they protect your assets, and they give you a regular income in the form of interest on the amounts that you're loaning out. And what the aim of that to do is to offset any movement in the value of your liabilities as well. So Joe talked about how you've got a big pot of money that's to be invested to offset your big pile of liabilities, i.e. all the money you have promised to members in the future. And that value of liabilities will change over time, and it will respond to a number of market movements, things like changes to inflation will increase your liabilities, or changes to interest rates will change the value of your liabilities. And And it tends to be that corporate bonds and government bonds move in a similar way to that. And so we call that a natural hedge. And those are the fundamental building blocks of your investment strategy. And when we are in a high growth environment, like we are expecting to see just now with economies starting to reopen and rebound, money tends to flow out of those safe assets and into those risky assets as investors try to chase return. So everybody wants a piece of the action, and as things start to open up, money flows from those less risky assets to the more risky assets. And what that does is drives the prices down of those bonds. And that's what you're seeing coming through on your investment report. Your returns on your stocks did well, and you got a negative return on your bond portfolio, which is perfectly normal in an environment such as this one. You also have allocations to other asset classes like property. And when we talk about investments in property, we're not talking about flats or houses, we're talking about UK commercial property. So things like big office blocks or industrial warehouses. And you're invested predominantly in the UK when it comes to property. And you can imagine the impact that COVID has on UK property as a whole. UK property is still ticking over. You actually have a low allocation to things that haven't done well. You'll have all heard of the death of the high street and retail in general. Retail property has really struggled. But where you have a struggle in something like retail property, you have a boom in things like industrial property. So Amazon warehouses, for example. COVID has a huge demand on things like online shopping and online retail. And all online retailers need to house and store their products, which then boosts demand for industrial properties. So although COVID has really impacted on the retail sector, it's actually benefited the industrial sector. So it's kind of given with one hand and taken with the other when we look at UK commercial property as a whole. Offices as well have also started to, people have started going back to work, and office capacity, despite less people being in the office, a lot of offices need to be bigger to maintain social distancing, and so a lot of the demand decline people were anticipating for office property hasn't come through as much as we had anticipated, just because people are needing that much more space to accommodate the staff that they've got. People can't be crammed into an office as much as they were before, which is actually in offset demand for space in offices. So your UK commercial property holdings are still ticking over. And you've got a couple of more allocations to things like alternatives, and these are relatively new asset classes for the fund. I'll talk about them in a moment, but just what I want to do is take it onto page, can't see what page it is over overall package, page 5 of the investment monitoring report. And that gives you an overall view of the fund and its strategy. And down the left-hand side, you've got some commentary of asset allocation. And then you've got the table in the middle, which gives you the valuations at the end of last quarter, the end of Q1, and portions in which you invested in all of those asset classes. So you'll see that you've got your UK equities at the top, your global equities underneath, and you've also got an allocation to something called a diversified growth fund. And that's just a special type of fund that's run by an investment manager called Bailey Gifford, and they invest in lots of different asset classes for you. And it's just a cheap and easy way to get access to lots of different growth type assets that aren't just stocks and equities. As Joe said, you are actually relatively small as a fund, and this is an efficient way for you to gain access to lots of different investments without appointing 10 different managers with 10 different mandates, just because you don't have the scale to do that. So Bailey Gifford will go away and invest in lots of different things for you, trying to generate a decent level of return. And the later pages in this report do go into more detail on each of these individual mandates, so you can digest them at your own leisure. But the overall key thing to take away is that nearly 70% or around 65% of your target allocation, or 70% of your total investment strategy, is invested in these high growth investments such as stocks and shares or diversified growth. And that the pure purpose of that is to try and generate as much return as your risk tolerance will allow in order to offset the cost of funding the pension scheme. The pension scheme is very expensive to fund, And because within the LGPS you are open and continue to accrue pension benefits, we need to retain a high level of investment return in order to offset those costs. So you will always see a large proportion of your investments invested in those risky type assets, which does mean that your funding position will fall around over time as equity markets move and as bond markets move. Your funding position is absolutely not static. We'll expect that to go up and down just with the volatility that you have inherent in your investment strategy. Then you've got your second bucket down, your income bucket, and it's, although it's in the title and providing you income as an investment allocation, this will also provide stability to your funding position. We wouldn't expect asset prices within these buckets to jump up and down as much as you would with your higher growth assets. So you've got your property in there, and you've got what's called private debt in there as well. And I won't go into too much detail about that, but that would come under your bucket. So anything not traditional stock and shares, not traditional bonds, kind of classed as alternatives. And so property is UK commercial property like we've spoken about, and then you've got your private debt as well. And it's very like bonds in that you're lending money to companies, but those companies are not listed on the stock exchange and therefore can't issue corporate bonds in the same way as large listed companies can. So they tend to be smaller, more niche companies, but you get paid a premium for lending to those types of companies. And it's important that we distinguish between the pension fund and your investment managers. So the pension fund itself is going out and directly lending money to these companies. You are investing in a pooled investment fund. You're putting your money in, other investors are putting your money in, and then a specialist asset manager will go out and invest that money for you and provide you with the return. And then your third bucket is your protection bucket, and that is your fixed income. That's just another word for bonds, and that's your allocation to both corporate bonds and to government bonds as well. And the role of that I've already spoken about is to kind of naturally hedge your liabilities. They tend to move in the same way as your liabilities move, the value of all the pensions that you have to pay out, and that will provide stability to your funding position as well. We don't want to put everything into the high growth bucket, because otherwise your funding position will jump around wildly and you'll end up having to pump loads of money into it. If you lose lots of money, it's too much risk to take. And similarly, we can't have everything into your protection assets and just earning a tiny little yield, because it just won't be enough to fund your pension scheme. So as part of the valuation process, what you have to do is arrive at an investment strategy that gives you enough expected return to keep your contributions at a tolerable level, but not too much that it provides you with undue volatility, because at the end of the day, you have promised these pension benefits to members and they have to be funded. And they can either be funded through investment returns or contributions. And if you take too much investment in and lose a significant proportion of the fund, then it will have to be reflected in contributions, which can ultimately be very detrimental to the members of the fund and the employers within the fund that have to pay those contributions. And so in order to maintain that expected level of return, we set what's called your strategic asset allocation, i.e. agreed bucket or agreed percentages in which we say, okay, you will invest 65% of your assets in this bucket, 15% of your assets in this bucket, and 20% of your assets in this bucket, for example. And that's what your benchmark allocation is in that table from the second one from the right. So that's what you're agreed to invest in, and that strategy should give you the level of expected return that you need that is set out and as agreed with the actuary as part of your valuation. And then the next row in the active portion is how your assets are stacked against that investment strategy. So you'll see that you're actually overweight to those growth assets, that equity assets, and that's because they've done so well over the past 12 months. They've grown in a big proportion to the rest of your assets than the other buckets that you've got there, which means that you're now overweight relative to the strategy. And so much so that we'll be considering some rebalancing action, which is getting done behind the scenes outside of the committee meeting, because you have agreed to make a couple of more allocations or tweaks to your strategy, and we will then factor in that balancing of your portfolio back to strategy when we undertake those changes. So really the key takeaway from this page is that you're invested in a variety of things, but broadly they are split into 3 buckets, and those 3 buckets provide you with different characteristics that all help to generate the level of expected return you need to fund a pension scheme. You need your high growth asset to generate that return, but they're too risky, so you can't have all there. You need your income bucket to provide stability and to provide you with regular income to help pay member benefits. So you will get regular income from rent from property or interest from your private debt. And that money coming in will then come back out to help pay member benefits. And if you're using that income to pay member benefits, it means you're not eroding the value of your total funds to pay those member benefits. You can keep that there and just use the income to pay those member benefits. And ultimately, that's the objective to get to. When we talk about a fully funded pension scheme within the LGPS, we talk about getting to a steady state, i.e. you've got your liabilities, you've got a big pile of money, the money coming in the form of investment returns and contributions equals that going out on a monthly basis to pay those member pensions. And if we can maintain that at broadly 100% funded, then that's a successful running of the pension scheme. I'm going to pause there before I talk about manager performance and what that means for the funds before I check if anyone has any questions. Any questions? So what does all that mean for the fund? So stocks did well, bonds didn't do so well, and that's just because of the sentiments in markets this time. So in aggregate, the fund returned 1.6% over the quarter versus a benchmark of 1.4%. So a positive fund performance. And your fund is ahead of strategic benchmark over all periods considered. And what that means is that you've got your investment strategy. If you were invested perfectly in line with that investment strategy through all those periods, that would give you your benchmark return. But in reality, you don't stick too rigidly to your investment strategy, and that's just because things are constantly moving. Or your managers might be outperforming relative to what their target is, for example. And that means the fund has actually done better than we would expect from your investment strategy, and that's mainly driven by your higher allocation to equities, which has done what we call overweight in those assets. And because they've generated really positive returns, the fund has actually done better than the benchmark strategy. And from all of those positive investment returns, the fund is now valued at about 700 million, just shy of, and that represents an increase of 10 million from the last quarter. In terms of your manager performance, that is in more detail on the latter pages, and I wasn't going to turn the pages on them. The only thing I wanted to point out was that your new allocation to private debt with Goldman Sachs is still within its drawdown phase, i.e. you have committed a proportion of your assets to that mandate, and that will get drawn down in chunks over the next couple of years. So it will be a little while before we see the valuation of that getting up to what we expect it to be, and also before any meaningful performance figures are available from this mandate. And that's just typical of private alternative asset classes, such as private debt. And we will go into that in more detail about your asset class shading section. So based on estimated market movement since the end of the quarter, the estimated funding level of the total fund is actually around 104% funded. So you're in that window of 100% funded. And so what we'll start to see with the investment strategy is coming out of some of those more risky assets, i.e. locking in those gains. Those risky assets have done really well for you, but now you're 100% funded. You don't need to be taking as much risk as you previously had been. So we want to walk away from the table while we're winning and disinvest out of some of those risky assets and put them into alternative asset classes that provide stability. Now that we've reached that 100% funding band, we want to stay in it, and we don't want it to be bobbing around necessarily. So a lot of the work that's been agreed as part of the strategy review and that will be implemented over the next couple of quarters is to to lock in those gains. You've done really well to walk away from the table whilst you're winning, reduce your allocation to equities, and put them into alternative things such as private debt and infrastructure, which Joe is in the process of setting up the infrastructure mandate with partners, and that was selected by the last committee towards the end of last year. In terms of monitoring your managers, Hyman's Roberts can do that for you. So we have a large investment research team that keep on top of all the investment managers that invest on your behalf. And there were no changes to the ratings of those investment managers for the period. That's also recorded in your investment monitoring report, just on page 7 of the report. It gives you a little bit of business updates and personnel changes within the managers, but you do see your managers on a regular basis, and that gives the committee the opportunity to challenge and ask questions of their investment managers. And if there's anything that we think is pertinent, we would flag it as part of the report. Then the later pages of the report just go into a bit more detail in each of the mandates. It will show you the types of investment that you've invested in, the allocations in which the manager will invest, and the performance of those mandates both over the short and long term. And then the strips down the side give you a bit of running commentary as to how the mandate has performed over that quarter and why. And it'll give you different metrics depending on the different type of mandate that you've got. So whether it's a property mandate or an equity mandate, there'll be different types of things that's important to look at when you're evaluating the performance of those mandates. But other than that, that is a whistle-stop tour of the investment strategy for the fund. You're invested in a diversified portfolio of assets. That should mean that regardless of what happens in the market, over the long term, you should generate sustainable returns to help fund during the period of the pension scheme. And we will go into more detail about asset class training, about all the different types of individual assets, how they work, what are the key things to look out for. But overall, the fund has performed well over the quarter, performed well over the medium and long term. It's ahead of strategic benchmark, and you are now beyond that 100% funded target that we have been working towards over the last few years. So it's a positive story, and I'll probably pause there if anyone's got any further questions.
Emma, on page, it's manager ratings. Majority we have as adequate, and they've been adequate, I think, now for some time. Do you think they're going to improve? Is there a chance that maybe more people will invest in UK companies? Because I think that is Major's remit, isn't it? Is to invest in the UK. So do you think they will get better long term?
So there's two ratings there aside each manager. One is the Hyman's rating, which is our general view of them as an investment manager. So Majeti, as a UK active investment manager, we rate them as preferred, i.e. they are our top rated manager in that space. The next column along is the responsible investment rating, and that's our views on how well a manager responds to changes in environmental, social and governance policy, and how they incorporate RI, responsible investment risks, into every stage of their investment process. And currently Majeti are rated adequate, which is suitable. And I would caveat that these ratings are based on the information that they provide to Hyman's Robertson. We ask all of our rated investment managers to fill in a huge questionnaire and provide us with details of a variety of processes relating to responsible investment. And so then our research team will attribute a rating to them as to how well we think they document their responsible investment practices. Now, the equity ratings were done about a year and a half ago, so I would expect all of the managers to have made significant progress since they were last rated, and they are in the process of being re-rated. So it's more a watch this space, because I know I've spoken personally to Majeti on responsible investment, and they are doing a lot within this area. And the legislation and the onus on managers to be more responsible has only grown exponentially since they were last rated. So I would expect for this to improve over time, and it will be
have to say, Emma, the way you present it's so clear
Yeah.
and gives us such a good understanding of the true picture. So thank you very much.
Yeah.
And hope to be with you in person next time.
Any other questions, queries? No. Right. Have you now finished, Emma, or are you?
That's me finished in the investment section.
Right, so that's the investment position. That's number 5. So are we moving on to number 6?
I'm not proposing to say anything more on number 6 because Emma's covered most of that. That's around the funding position and showing us that we're 100% funding. Bear in mind this is an interim position, so it's as at the 31st of March. Investments do go up and down and liabilities go up and down, but it's that we're in the right place that we need to be, and as Emma mentioned, we're reviewing our investment, we're rebalancing our investment strategy to hopefully try and maintain that 100% funding. So it's the first time since I've been involved with the pension fund since 2009 that we've been 100% funded.
That's why you're smiling so much.
Smug mode. It's amazing what you can do by not doing anything. So I'm not proposing to say anything more on that one. And again, as I have said, we will have more detail from the actuaries at some point to explain what it is they do, what it means, how they do it, and explain their black magic arts. Thank you.
Any questions, queries? Anybody want to ask anything? As I said, on page 41 of your agenda, it gives the funding levels. I mean, I look at these and quite frankly, it's like looking at telephone numbers, isn't it? Right, are we going to item 7, draft financial results, which is pages 47 to 48.
Not proposing to say too much about these because I think we've covered the key points in sort of summary and some of the other activities. So this is the format of the pension fund annual report, pension fund accounts that will be included in as an appendix to the council's accounts and as part of the pension fund's annual report and accounts. The format is set out by CIPFA standard for the Chartered Institute of Public Finance and Accountancy, and it basically summarises the position, the income and expenditure for the year, and the balance sheet, effectively the assets and liabilities of the fund. We've got total assets at the end of the period of £690 million, which is just incredible and amazing, and we will go into more detail in it. We hope to bring the draft full financial statements and possibly, hopefully, as much of the annual report as we can to the next meeting at the end of July. So all 144 pages of it, another piece of paper for you to read, but we will summarise it for you and give you that information. So I'm happy to take any questions of the financial accounts as they presented. Thank you. And thank you to Joe for preparing this information.
Any queries, questions? Right, in which case we move on to item 8. Evan,
She's still needed.
I'm sorry.
would you wish to leave us or have you finished?
Yeah, I'm finished the investment section, so I don't mind ducking out now. I'll leave you to the rest of the agenda.
Thank you for your contribution, Emma. Very grateful. Thank you. Goodbye.
Lovely to see you and to the new faces as well. Speak soon.
Thank you.
Bye. So item 8, item circulated for members' attentions. You've got in front of you the indicative work plan.
In normal circumstances, as I was explaining to the new members over the break, when information comes through to me through email or bulletins, etc., then I would circulate those through to committee members outside of the meeting agenda, so that you've got the most up-to-date information. Then on this agenda pack, I will summarise the dates that they were sent and the information that was sent through. And then in the key areas of the main items of the agenda, as we're talking about it, they will refer to some of the items that have been circulated in between meetings. Because what I don't want to do is just hold everything up for every 3 months and then bombard you with a substantial pack of information that you don't have to digest in time for the committee meeting. But that to draw your attention to things during the interim period, and then highlight the key developments, etc., at the meeting itself. So there's nothing for you for this time because, well, there is. There's loads of stuff sitting in the main box waiting to send through to you. So I'll get that through to you after this meeting. So be prepared for the emails.
Can I just make a suggestion?
Yeah.
If new members haven't already, if you look at previous committee papers, you'll see how it's actually set out that Jo puts all the emails with the information that she's actually sent to us in the interim period, and links as well. So if you download the pack from modern.gov, you can actually go on to all the links. It's quite useful if you look at previous committee papers.
But I hope what I try to do is read all of the emails before I send them out to you. It's very rarely that I just click forward and send it out to you. There's usually a process if I've got the ability to understand it, or just simply sign up for this and read it yourself. But as I said, there is so much happening in the pension fund world at the moment that occasionally I'll try and limit the number of emails I send in a day, but sometimes it's just not possible.
Anything else on that? No. Right, if we now members' question time.
No.
Anything anybody wishes to ask, or are your brains full? Hopefully not intelligent people, but it does take time, and any new committee for you is going to take time to work in. If there is nothing else, then
Nope, no written questions received.
Meeting at 12:05.